Has asset management become a computerized safety net? Have people lost their appetite for risk? Well, GIB Financial Services recently hosted a discussion between active and passive asset management. To discuss this and other issues, I'm joined in studio by Glenn Gamsy, who is the head, or rather MD of GIB Financial Services. Glenn, thank you so much for joining us.
Thank you.
So, GIB hosting quite an exciting, I think, discussion around active and passive asset management. How relevant is this to the retirement industry? Just briefly take us through what actually took place.
Okay. What's been happening over the years is that in, for example, the States particularly, there's a huge move of assets from an active management to a passive management sector. So in South Africa, it's been a little bit slower, where you found quite a slow uptake of pension funds and individuals investing in passive assets. So what we did, and what we thought would be a nice idea, was to put through a debate, to get a debate together where we'd hear both sides. And that's quite important to us because we would very often hear the active manager's point of view, and then we would hear the passive manager's point of view. This time we actually wanted a situation where you would have the active manager and the passive manager hopefully arguing a little bit about it, but actively debating the decision of whether people should invest actively or passively. What we found is that in the States, there's been that huge move. South Africa, slow uptake. So we're trying to encourage members of pension funds or pension fund trustees themselves to move their money towards passive management. From a GIB point of view, the trustees of our umbrella retirement fund, umbrella pension and provident fund, called Destiny, decided a few years, or about a year and a half ago, to start moving assets from the active world to the passive world. The question is often why? Why do this? Well, the answer is mainly costs. Active managers charge a lot to manage your money. For that, they've got some terrific professionals, experts, specialists in their game who are going to give you a great return very often, but not always. And the argument is, do active managers, the majority of the time, beat an average return of the index, for instance? And the answer apparently is no. In fact,
is it all about saving costs, though?
It comes down to that largely, because an active manager can charge up to 2, even 3% of your money each year to look after it, where some statistics or a lot of stats show that the index, the all-share index, the all-share 40, etc., very often beats an active manager, where you might only pay 0.1 to 0.5% of your asset to look after that money, whereby an active manager is charging 2%. So the gross return is often better with the passive, never mind the net return, because that's now costs are taken into consideration.
Yeah, which brings me back to the question that I asked in the intro around people losing their appetite for risk. Do you get the sense that people have actually lost their appetite for risk, especially in this kind of environment?
Well, particularly South Africa. South Africa's members of pension funds, provident funds, are generally lower risk. They don't have an appetite for risk generally. Passive management apparently brings down that risk a little bit, and I say the word apparently quite broadly. So there's quite a lot of contention, and that is actually why we had the debate. What we do with the Destiny Umbrella Retirement Funds is that we actively blend the managers and the asset allocations between active and passive together to give what we call blending management. So that thereby gives you the best of both worlds. It gives you the active managers who are hopefully outperforming, who we very carefully select, but it also gives you the passive aspect or the passive element where you've got very low costs and you're tracking the index. So by blending the two together very carefully can perhaps give you outperformance, which is what we want.
Let's talk about your portfolio very quickly, because you did launch a new portfolio.
Correct.
At that briefing. Just take us through that.
That's quite interesting. What we did is it's called the Destiny Market Enhanced Portfolio, and generally it's quite an aggressive portfolio, but by blending active and passive, we've managed actually to keep the overall expense ratio quite low or very low, at the same time having that aggressive nature, but not too much. So it's quite a neatly packaged portfolio. Very importantly, it's not just available to the Destiny members. We've for the first time made it available, in fact our other portfolios simultaneously made available to the rest of the market. So pension funds and provident funds that even are not administered by GIB employee benefits, for the first time have the opportunity to participate in the Destiny funds and the Destiny portfolios, which outperform generally.
Exactly. Quite interesting. Well, we'll leave it at that. Thank you so much, Glenn.
Thank you very much.
All right, so that's Glenn Gamsy, and he's the MD of GIB Financial Services.